You're listening to Smart Metals Radio from the Hard Assets Alliance.
Hello and welcome to today's show with me, Andy Duncan, coming to you from London. Our special guest today is Matt Kerkhoff, who is the Research Director at Dow Theory Letters, and he's coming to us today from San Diego. In the show, we'll be talking about how the Dow Theory itself relates to gold and other precious metals, behavioral finance and market psychology, and the current global situation involving Russia, China, and the Western world. Hello, Matt.
How are you, Andy?
I'm very good. Now, you've worked for a long time with Richard Russell, the godfather of newsletter writers. What's been the most important thing you've learned from Richard and his 60 wise years of experience?
You know, I am blessed to have spent a lot of time next to Richard, and he's been watching the markets for about 60 years now on literally a daily basis. And so he's a wealth of information. I often joke that I learned through osmosis. I mean, just sitting in the same room with him, you can gain quite a bit of knowledge. But in terms of what's most important, I would say that Richard discovered sort of this idea that markets trend. And as you well know, Dow Theory has become kind of the foundation for modern-day technical analysis. And what I've really learned from Richard is that Dow Theory or technical analysis really needs to be done at kind of the macro level. It's a fantastic way of analyzing markets, but in today's world, I feel like too many people get down into the details of these really, really small indicators, and a lot of times they make the mistake of not kind of zooming out and looking at the big picture overall.
Yeah. Now, you've also got a background in psychology as well as kind of looking at the Dow Theory. And lots of research in psychology is done using statistical analysis. Now, how did you get from there to getting into predicting financial markets? Or was it actually quite an easy step because maybe financial markets are psychological markets?
You hit the nail on the head. It was, it was a very easy step into the financial sector because markets trade purely based on psychology. Some people still try to argue that markets are rational, but you can tell by market movements that that's generally not the case. And so at the end of the day, if you can exclude, for example, these high-frequency trading algorithms that are operating on very small margins, the bulk of the bigger trades made by the big market participants, there's a lot of psychology involved. And if you can learn to kind of analyze how people think and how they're going to interpret events and news, you get much more insight into their behavior, and it helps you get ahead of some of those trades.
Now, one of the most important things here at Smart Metals is the gold price. And the Dow Theory, created by Charles Dow all those years ago, it's got 6 major components. How does the Dow Theory currently predict the gold market? Gold's currently around $1,300. Where do you think it's going to go next?
So Dow Theory is only semi-applicable to the gold market, at least in its very traditional sense. But if you extrapolate Dow Theory at a more broader perspective, you're really just looking at market trends at different levels. And so we've had a nice run in gold since 2014. Obviously, everyone knows 2013 was a rather poor year. So far in 2014, gold has been bullish, at least in the short to medium term, until about this last week. And this last week, the last 6 or so sessions, we've seen some heavy selling. And a lot of it has to do with what's going on in the U.S. and especially with the Fed and actually the continuation of the taper, and now talk about interest rates beginning to rise sooner than a lot of other people expected.
And do you think that this taper will go ahead? Do you think it will continue, or will the Fed get scared at some point and reintroduce a lot of more money printing?
No, I actually believe that the taper will continue as planned. There's a lot more. If you start studying really truly how the banking system operates, you come to the conclusion that QE isn't as beneficial as most people think it is. A lot of people will say that our economy can't last without QE, but they're using an oversimplified model of this quote unquote money printing, and so that's the same reason they've been basically wrong about hyperinflation for the last 5 years or so. So I do believe the taper will continue. Because I don't believe it's had much of an effect. And I don't think it's going to have an extremely adverse reaction on the economy either.
Okay, now the Dow Theory Letters themselves and Richard Russell have suggested for a long time now that there's going to be a blowout phase with gold. And this hasn't actually happened, of course. Now, do you believe that this predicted blowout phase will come at some time? And if you do, when do you think it's going to happen?
It's very possible that in the longer run we will see another blowout phase in gold, but I don't expect to see that anytime within the next couple of years, at least. And that has to do with some of the upcoming headwinds that gold is facing. We are starting to see a little bit of improvement in the economy, and so the desire for gold as a hedge against catastrophic events is beginning to wane ever so slightly. And it's important that we look not so much at the underlying fundamentals of the economy, but the world's perception of global economies. And so it's really the perception of economic stability that matters. So that's one headwind. And then the other headwind, it really has to do with a rising interest rate environment. Gold is going to have a little bit more difficulty over the next year or two if interest rates rise, because the opportunity cost of holding that gold is going to go higher.
Now, James Dines, who you might know, he has his own set of ideas based on mass psychology, and his rule set contains very specific rules for how gold behaves as opposed to any other kind of investment. Do you think gold is a special investment, or to you is it just another trading commodity?
No, we don't look at it as just another trading commodity. And part of that is because we believe that the rest of the world doesn't look at it as just a commodity. Large portions of the world view gold as the only real money. And we talked a little bit about the psychology of markets. You have to take that psychological component into your analysis. Otherwise, you're not accurately assessing how other people are viewing this particular commodity. So we do look at it as really a form of money. And we look to a lot of other indicators to see whether other people in large populations are adopting that belief or walking away from that particular belief.
What would be your recommendations, your general recommendations for how people should have gold in their portfolios? What percentages of gold should people have, and should they use paper gold or should they hold physical gold?
It's really hard to make a comment on what percentage of people's allocation should be in gold. That tends to be very personal. But we heavily recommend owning gold in physical form. We are not fans of playing the paper gold markets unless you're just looking to sort of take advantage of the trending in the gold price. We tell a lot of our subscribers that one of the best things you can do is actually take physical possession of it and maintain that physical possession of it. A lot of these paper traded investments, they carry a lot of counterparty risk. And there's a chance that if anything did happen, if the price of gold did spike, you're still relying on that counterparty to make good in order for the value of your investment to be there. So we prefer physical by far.
Okay. And what other investments look good to you at the moment?
Well, most of our work focuses on the domestic U.S. equity markets. And so at this point, we've reached higher levels. We've still been in a bull market since 2009. And based on Dow Theory and a number of other technical and fundamental indicators we look at, we're still in a bull market. So we still recommend being long, particularly U.S. equities. We've generally recommended limited exposure to bonds, shorter-term bonds being, I guess, more okay than the longer-term bonds. But we do see interest rates slowly creeping up as the economy continues to gain momentum. And so as that happens, we expect to see better performance out of the equity markets than the bond markets going forward.
Now, I just wanted to move on before we finish to China. It seems to be in a strange situation. It's created this $23 trillion credit bubble, if you read websites like Zero Hedge, and this bubble may be on the verge of imploding and collapsing. What's your view on China, and what's your view on China's general effect on the rest of the world's economy?
That's a great question. I actually just gave a talk on China's impact to the global economy. And our view is that China is actually at this point a major risk factor. A lot of people who aren't close to China tend to view it, they look at the headline statistics like it's fastest growing economy and now the world's second largest growing economy. But if you start digging into the details, especially within the banking system, there are a lot of cracks that are beginning to show kind of beneath the water. And so China's banking system is kind of a mess, and it's convoluted just like ours is. And so, for example, they're having major problems with the shadow banking sector. They're trying to figure out how to regulate it. And they've taken on tremendous amounts of debt and used it for basically infrastructure spending. And they've completely overbuilt in China. I'm sure you've heard about the ghost cities. They have malls that are vacant. They have bridges that go to nowhere. And a lot of this was done from a stimulus perspective to try and, keep the economy growing. Well, they can only rely on that so long. So they have that problem, plus they have a lot of cracks in their financial system. And so we're actually looking for a major catalyst to come from China that's going to send, shockwaves through the market, just like we had earlier in January with the mini currency crisis.
Now, a lot of people have been relying on China to kind of be the engine which restarts the world's economy. If it does collapse, as you seem to be implying there, do you think this could be the beginning of a major kind of global world kind of depression?
I hate to use terms that strong, but I don't believe that. I believe China's growth will continue to slow, and they probably will not be the growth engine for the global economy that they have been for the past few years. But China is somewhat notorious for doing whatever it takes to keep the system together. And so because their economy is somewhat isolated from the rest of the world, if things do implode there, it may not have as far-reaching effects as, for example, when the subprime crisis in the U.S. hit. And part of that, for example, is because most of China's bond markets are actually owned by China's banks. So the risk is really built into China and not as well diversified around the rest of the globe. So we do look for problems from there, but I wouldn't say that doom and gloom is inevitably on the horizon.
Now, slightly related, because we have Russia and China working together in certain ways, we've got this black swan situation in the Crimea and the Ukraine. Are you taking a look at that from a financial perspective? And if you are, what effect do you think the Crimea-Ukraine situation is going to have on global markets?
Well, that's a developing story, and every day it's interesting to see what's going on. As far as I can tell now, it looks like the U.S. and most of the other G7 countries are trying to continually expand the sanctions that are in place against Russia. And it's hard to say where this is going to end. But if these sanctions end up becoming significant and are in place for a long time, it is going to hurt global trade, which is going to hurt all the trading partners involved. And that's pretty much everybody. So from a larger macroeconomic perspective, we could see a slowdown there. And then obviously if we have the unfortunate event of it developing into something stronger or more fierce, that could also, ripple across the global markets. And it's interesting watching the price of gold, how it's reacting to this crisis. And it seems like investors tend to be shrugging it off.
Now, if I can just finish on a more positive note, where do you think the world recovery is going to come from in the end? What's going to get us out of the current malaise that we're in, do you think? Well,
I can't say that it'll be one specific country. For the last 10, 15 years, our economy has continually become more globally connected. And so we all rise together and we all tend to fall together these days. And so I don't believe that one particular country, such as China has done in the past, is really going to lead the way. I believe we're going to all sort of rise slowly and fall slowly together. And the one thing I'll add to that is, as economies become larger and larger in size, it becomes more difficult to maintain these high growth rates that basically everything is predicated upon. So you can use the analogy of a small growth stock that grows and grows and grows, tremendous growth until it gets big and it can't maintain that growth rate again and turns into more of a dividend-paying value stock. So we're starting to see that with a lot of the world's major economies. It's just very hard to get high growth levels out of these gigantic economies.
Okay, it's been great talking to you today, Matt. How can our listeners find out more about the Dow Theory Letters?
The easiest way is to go to our website, which is dowtheoryletters.com. And our homepage gives you all the information you could want to give us a try and find out what we do.
Thank you very much for your time today, Matt Kerkhoff.
Thanks, Andy. It's been a pleasure.
Subscribe to the Smart Metals radio show on iTunes. You can also visit us online at hardassetsalliance.com/radio, where you can subscribe to our free mailing list and receive our free Smart Metals newsletter. For anyone who wants to set up an account with the Hard Assets Alliance, as a special offer, we shall be waiving opening and setting up fees. Listeners who'd like to speak to a live rep to walk through the registration process can call 1-877-727-7387. That's 1-877-727-7387. I'd like to thank Matt Kerkhoff for joining us on today's show, and I'd like to thank you too for listening. Until next time, goodbye.